Hello, everyone, and welcome to another edition of DREIA's Street Talk. Today, we're going to be speaking with Cynthia Trammell of R3 Ignite. Cynthia is a good friend of ours, and actually, we met at Next Million Mastermind. Wasn't that fun?
It was a great event. I'm so happy to be a part of that.
So, Cynthia is a real estate investor, but she does what many of us aspire to be. She does partnerships and syndications. Now, we're going to talk today about something that a lot of investors hear and want to know about, Cynthia, and that's syndications. But first, tell us a little bit about Cynthia and what you do.
That's great. Well, thanks, Jim, so much for having me here today. So, I am Cynthia Trammell, and my company is R3 Ignite. It is about igniting relationships and resilience and all those returns to come to your full potential. And so that is my company. I am also part of Trinity Real Estate Investment Group, and we do buy and sell multifamily properties through joint ventures, syndications, and any way we can get them.
So, let's talk about the word syndication. Can you just give us a short definition of
Yeah.
syndication versus general partnership, for example?
Yeah. I've sat through so many classes on syndication, and sometimes it's usually done by syndication lawyers, and it can be so confusing. But syndication is really just about any time you're going to buy a property and you are going to leverage other people's money. So someone's going to bring money in to help you buy a property, and you are going to give them a return on that investment that they bring in. You have now syndicated a property, and the SEC has strict rules about that syndication. And it doesn't matter if it's a $1 million property or a $100 million property. If you bring in investors, five or more, that you promise a return to, you are now syndicated.
Okay. So you sent me a note saying there are two types of syndications, and one allows non-accredited investors. So tell me about the two types of syndications and explain what is accredited versus a non-accredited investor.
Great questions. So you usually will see these two types of syndications, right? So one is a 506B and one is the 506C. Let's talk about accredited versus non accredited. So, accredited, those are people that they have to have an income, W-2 income of $200,000 more, $200,000 or more a year, or you have to have a net worth of $1 million. And if you can do that, you are considered accredited. And one of the things the SEC does is they are very strict about how you bring in people to your syndication. You can't just go out to somebody on the street and just say, "Hey, do you make $200,000? Would you like to be part of my deal?" You have to have a relationship with them, and you have to be able to prove that you have a relationship with somebody before you go and invite them into your offerings. And then a non-accredited investor is basically anybody who doesn't have $200,000 a year. Maybe you make $100,000 a year, but you have a little bit of experience in real estate. You would still be considered a non-accredited investor. And the SEC defines this very strictly. So the 506B, you can have non-accredited investors, people that um, want to come in that aren't making that kind of income yearly, but there's still a place for you to come in. But you have to have a previous relationship with the person who is bringing the deal together. And then for the 506B syndication, then you can have it has to be all accredited investors. So it has to be all people that have that $200,000 income or $1 million net worth. But the one thing are starting to see more with that 506C is you can advertise. So you don't always have to have that pre-relationship with somebody. You can actually put it on your Facebook page. You can put a big mass email blast out there saying, "Hey, I've got a deal. Would you like to know more about it?" There's still some rules you have to follow, but that's the advantage of the C. And somebody can come in with $5,000, where a 506B, you're usually going to see entry of about $50,000 minimum or $100,000 to get into a deal. So that's the difference between the two. Now, there are some deals that they might allow a percentage of non-accredited investors to be able to come in at like $5,000, $10,000. But every syndication has to have like a PPM, right? It is your private placement memorandum. And it's very important to have all that legal documentation written about who can come into a deal and who can't come into a deal.
Okay. Um, so as you as a syndicator, you as whatever you're named in a syndication, are you the limited partner, you're the general partner, or what's the term for what you are?
So two sides to a syndication. The general partners are the ones who bring the deal. They're the ones who find the deal. They're the ones who fund the deal. And you will see the general partners are usually made up of somebody who has one, the net worth, someone who's going to sign on the dotted line on that loan and carry it, right? And then you've got somebody who brings the deal, and they're usually a part of the GP because it takes a lot of time to underwrite and find these deals. So you want to be part of that general partnership. And then the most important part is you've got to raise money. Because if you have a $10 million deal, you might have to raise $4 or $5 million. Don't know about you, Jim, but I don't have that sitting in my bank, right? So
Exactly.
now we've got to go find people to bring in, and we call it a raise. You've got to bring people to come in and bring money into your raise. And so that is what the general partnership is. Now, limited partners, basically, those are your investors. They are your passive investors. They come in, they bring money, they don't have any voting rights, they don't have a lot of say um, because they are part of that limited partnership. They are almost silent partners, shall we say. You bring in your money and you get a return. And then your GPs keep you up to date with everything that's going on about the property. Now, go ahead, Jim.
So the originator of a syndication is the general partner. The
Yes,
participants, the people who put up the money for the syndication, are the limited partners. Is that correct?
correct. Correct.
Okay, so how much money do you as a syndicator need to start with? I mean, for paperwork and promotions and all those kind of things. And then how much would you typically look, let's say you're looking at a $5 million deal. How much would you need from limited partners? And how much do they typically bring to the table? 50, 100? What do they bring?
Yeah. Yeah. So syndications, it's a you have to underwrite and you have to make sure that you get your raise right. But included in that raise are going to be lots of things, right? The down payment for the loan, which right now banks are agency loans are around 30%. You might get 25% down. The LTVs are going to be 70%. So that means you have to come up with 30%. So if you've got that $5 million property, you have to come up with 30% of that out of pocket. And then a lot of properties, you're going to need some CapEx, right? They may need a rehab, they might need renovations. Things are going to go wrong, and you've got to have that money. We kind of average it that you need about 45% of that asking price for your raise. Okay.
So the syndicated people, the syndication ask is about 45% then in this case.
Yeah. Yeah,
Okay.
that's kind of a pretty, average number. Sometimes it's a little bit less, but by the time you wrap in all the fees and all the appraisals and all the renovations and the CapEx and all the escrows, you're going to hit about a 45% of that full sales price. That's kind of what you're looking at. And that's your raise. So it's important that you find a lot of people to come in to that raise. So then that's how you go and you find your your passive investors, and those people 50,000, 100,000. That's the most common. Your PPM will dictate 50,000 is the minimum to come in. Sometimes we see 100,000, but most of the time it's 50,000.
In a syndication, when you present your offering, you've already identified a property. Is that correct?
Correct. You are already under
Already done.
contract.
Okay.
Yep.
It's under contract?
It's under contract. You've done your due diligence and you are raising money at that point. And we encourage, you're always raising money. That's the name of the game. It's always capital raising because if you just start to look for $5 million, or in this case, maybe 2.5, $3 million, that's a lot of $50,000, right? So
Right.
you got to start ahead of time. You're building relationships, you're networking, you're going to RIAs, you're going to meetups, and you are working on meeting people that have money. And it doesn't always have to just be cash in the bank. You can have an IRA that you can turn that into a self-directed IRA. So there's a lot of other ways. You can use 401ks. There's a lot of different ways to use monies that maybe you haven't thought about to invest in these properties.
So, how do you underwrite? What's your initial way to underwrite? You see a nice property get down the road for 5, 6 million bucks. So, what are your initial steps as a syndicator for underwriting the deal?
So underwriting is a long, it's a little bit of a complicated process, but the main goal is when you underwrite, you've got to make sure there's enough cash at the end of the day to pay your investors. So we call it cash on cash, right? That's what we're looking for, is we want to get 10, 12% return that we can then have enough money to get our investors that return on their money. So we've got a couple of deals that we've done where when up on time of sell, we were up around, 30, 40% return on investment. Now that's high. They're not all like that. We have stumbled into a couple of great properties. But if at the very end of the day when you sell, if you can get your investors 20% annualized return, that's excellent. That's excellent. Your investors will be very happy and they'll want to do more with you.
So you do it just like the rest of us do. You sit and look at your capital outlay for the property, your rehab, and then your revenue. I mean, do you have a computer program? Do you use AI? What do you do for your initial look?
We do use AI. We have an AI system that runs it through. We set our parameters. We put those prompts in and tell it what we want to achieve and what we're willing to look at. And then it runs it. And then we get a kind of a pass fail or needs to dig deeper into it. So the underwriting process is the most important part of the whole thing because if you can't underwrite well, when that deal goes south, it just doesn't go south for you. It goes south for your 35 investors that trusted you to do it right.
So that brings me to we're in, we're renting, we're following our plan. So how do the returns work during ownership and at the end? And do you have in your syndication, do you have a planned end of or get out date, so to speak?
Yeah. Yes, absolutely. And that's part of that PPM. So you're usually going to go into it knowing this is a 5-year hold. We're seeing a lot of 7-year holds right now, but mostly with multifamily, it's a 5-year hold. Some people want to get out early. You have to track the market and track your property on how it's doing to know when that exit is. But you have a good idea of when you want to exit when you get into that. So also when you're looking at GP and LP, there's a split, right? So the most common split is a 70-30 split. And the simplest way to explain this is for every dollar you make, the GPs take 30 cents. And your LPs, based on the money they brought in, get a percentage of the 70 cents that is left. So,
So the general partners earn 30% for what they've done. Now, how
correct.
much money, if any, does the general partner put in the beginning? Or are they the ones who organize the loan from the bank and all that kind of stuff?
They organize it all. They will organize the type of loan you're going to get, the interest rate. They asset manage the property. They bring in everything. The property manager, they are in a day-to-day grind watching and overseeing this property so it makes money. The best general partners and the best asset managers are the ones that are watching and predicting and looking ahead to see if there's any stumbling blocks in the way. Because, for example, as we all know, over the last year or two, we've all gotten the gift of your insurance being like tripled. So I know on all our properties, we had a great insurance price, and then we got a letter that said, congratulations, we're now going to raise your insurance 15, 20%. And for those people that did not underwrite well, it totally blew their deals. and now they're struggling to make their cash because it's the cash at the end of the day. You have your NOI, right? You get your income, you take your expenses out of it. That's your NOI. Then you've got to pay your debt back, your mortgage basically, and you've got to pay any reserves to your bank. And that number at the end is what you split. And it's what you split with your GPs and your LPs. So if you have $1,000 left, your GPs will take 300, and then your LPs take that 700 and split it up based on their percentage. And that's what you get at the end of that month, technically. Now, most GPs will pay out every quarter. They don't usually do month to month returns to you. But then at the end, most of the time, and what we're seeing in the market right now, the big win is at the end because once you get in, you renovate just like you would with a house. You go in, you renovate, now it's valued at more. So you get appraised more, it gets valued more, and then you sell it and you get all that cash sitting there between what you bought it for, what you're selling it for, and then everybody gets to split.
So let's talk about the risks for a minute. So based on what you said, it's the general partners who sign on the dotted line for the loan.
Yep.
They become liable. Limited partners are just like you learn in Business Law 101, right? They're just limited to their investment. They don't lose anything more than their investment if they lose at all. Is that correct?
Yep.
So what are the other risks?
Well, this, as you know, real estate is the business of risk. It is the risk because the market could turn. You can have a pandemic that you weren't expecting. There's so many unexpected things. And again, I'm going to go back to the underwriting. That's why you have to underwrite for when something goes wrong because it will, guaranteed. And what we've seen is a lot of people, when the interest rates were down 3, 4%, people were getting into deals and biting off more than they could chew. They were like, oh, I'm just going to raise rents. I'm going to get all this income. And then the market went, oh, congratulations, your interest rate is now 8%. And they've bellied up. And if the GP loses, the investors lose. And there's really not a lot of recourse for that. The bank will come call the note. And that is the risk. So I would encourage anybody that's wanting to go in as a limited partner, do your research on your general partners. Ask questions about them. How many of these, properties have they bought like this? What is their main course of action? How do they plan on getting out of this? What is the exit plan, right? Like you asked earlier, Jim, what's the exit plan? Because if it's just on raising rents, that's a pretty loose argument these days. It's got to be more than that.
So they clearly you want to see that they're adding value so that rents can increase, thus
Correct.
increasing the values. So what are the potential rewards for the GP and the LP, limited partners?
Yeah, the rewards are just having a great successful property and having GPs that communicate well. So your LPs, I hear it from a lot of LPs sometimes, man, we haven't heard anything about the property. We don't get any newsletters. We don't know what's going on. And that is just that you will sink your ship. I mean, because these investors, if you do well, and I mean, just think about if we put money in, right? You put in $100,000, you do a deal, you walk away with maybe 200 or 250. That's a pretty nice return. I would do that any day. If it is a good um, return and it is a healthy relationship, people will invest over and over and over again with you if they trust you. So you've got to be trustworthy, you've got to have integrity, and you've got to be transparent. If things aren't going well, you've got to tell your investors, hey, we're hitting a rough patch, and here's how we're going to fix it. And when things are going well, tell your investors things are going well, rents are going up, we've hit the mark, we've renovated this percentage. So your investors know what's going on all the time. And then that's the success. It's not just always the money. It's relationships that have worked, that are true and trustworthy. And that's the greatest reward of syndications.
So let's talk about inventory and availability now. Is it easier to find a deal now that interest rates are high, or is it more difficult?
It's more difficult. It's definitely more difficult. A lot of investors have been sitting and waiting for them to start dropping. And it's not just the interest rate going high. We would work with that. There's a lot of us that have been bold and we've been putting offers out. It's that we're seeing real extreme increases in property taxes and in that insurance. So where those percentages used to be much lower and we could get our expenses down around, 45% of our income, now we're seeing 50, 60% of our income, and things are just not underwriting. So, yes, the interest rates do not help by any means, but it's also some of these extreme radical increases in other expenses.
Well, that would say to me then that sellers have not yet become realistic about the value of the properties because a property is only valued as a function of its net income. It's not like a house because all the other houses are selling for 800, it'll sell for 800. It is related specifically to income.
Correct.
So, do you think that a time will come where sellers become more reasonable, or is there just too much money floating around?
I don't know. I would like to think that, but most sellers are going to want retail. They are still asking for retail, and some of them are more realistic than others. Because here's the thing: how motivated are they? If they can hold it for longer, they will. They'll wait until somebody, but there's a lot of investors too that will go in and say, "You know what? We're gonna get maybe 5% return and we'll make it work." I'm telling you, in 2 or 3 years, 5% return is not enough to reward your investors for what they brought to the table. So,
So, how would someone get involved in a syndication if they want to?
best way is to network. There's a lot of go into LinkedIn. There's a lot of people on LinkedIn that do have properties going right now or that are part of groups that you can get in. Find out what they're doing. Look at what they're buying and go to their website. A lot of these investors, these syndicators will have a place on their website where you can say, "Let me check out your deals. What do you have going?" So, networking is the best way. Going to some of the meetups that are in your area, and you can Google these. You can find out where all your meetups are, your local REIAs. They know a lot of this information too. So that's the best way is to get in and find out what these other groups are doing and what their offerings are.
So, something to wrap up, give me a few questions that a potential investor in a syndication should ask the syndicator.
What is your experience? How many of these properties have you bought and sold, and what were your returns?
That's
That'd
it.
be the first one. I mean, it's your track record, right? And the second one is what is their plan? Are they conservative? Are they, how do they communicate with their team? How do they run their business? What processes do they have in place as far as asset management? I see that's probably the weakest spot on some teams is if you don't know where your money is and you can't tell your investors, that's scary. So they need to know what is your plan for asset management? What resources, what programs do you have in place? Do you have scorecards? Do you, give out that information on a quarterly basis or a monthly basis? So find out what their processes are. That's the most important thing too.
All right, Cynthia, this is very interesting, and thank you for the definitions.
Thanks,
And
Jim.
we know your company is R3 Ignite. We're going to have you back, and we're going to talk more about general partners and limited partnerships. But I wanted to get the word syndication out of the way. I hear it all the time, and people say they may or may not know what they're talking about. So now we can all know.
Yes. It's a
Thank you.
big word. It's a kind of a it's hard to understand what it is. So, thank you for this opportunity because there's a lot of great opportunities for people to be a part of these multifamily properties.
Uh, Thank you.
Thanks, Jim.